This is the mechanism for how markets work. And you know what? If you're like most of the traders that I've talked to in my whole career of teaching traders, you probably never thought about this and you didn't have reason to, but it's super important stuff and people just don't understand it.
Hello, Wealth Builders. You're listening to Wealth Building with Options. Here's your host, Dan Passarelli.
Hey, Wealth Building family. Welcome to episode 45, Abracadarium. But before we jump in today, let's talk about how you can get the most out of the Wealth Building with Options community. Help grow the Wealth Building with Options community by subscribing to it in your favorite podcast app. If you're already a listener, you can support the show with a paid subscription. When you do, you'll get lots of great stuff. You'll get video extra podcast episodes so you can get hands-on video training and PDFs on things that we talk about on the show. Subscriber-only posts from our Substack, where I drill down on a stock, event, or trading opportunity and share trade ideas. In those same posts, you'll get all my covered call and cash secured put trades that I'm making in my real brokerage account. You'll get access to our monthly online Ask Me Anything webinar, and you'll get our unusual options activity alerts on options income trades, credit spreads, actually, and much more. And the best part is your paid subscription helps keep this show on the air. All you have to do is go to wealthbuildingpodcast.com. That's wealthbuildingpodcast.com and choose your subscription level. I was listening recently to a podcast on the Roman Empire and how they educated their children. And as far as teaching them writing skills and that kind of thing, as far as the young kids do it, well, they did it in kind of a weird way. What they did is first they had them memorize all the letters in the alphabet in order before anything, before they even knew what the letters looked like or sounded like. And mind you, this was before Mozart wrote Twinkle, Twinkle, Little Star, which, if you didn't already know this, is the same darn music as the ABC song. Yeah, we just ripped it off from Twinkle, Twinkle, Little Star. So, geez Louise, these kids, they're like A, B, C, D. They don't even know what the things mean, but they got to memorize all these darn letters in order. And then after that, they would write them. So then they'd finally know what they look like. And then after that, they would find out what they sounded like. So basically, they started with what they call the Abracadarium, which is basically just like, these are the letters, and that's it. Then finally, like way down the road, once they know what they sound like, then they finally put them into words and that kind of thing. Now, modern understanding of how brains work and education works, we know that that's actually not the best way to think about it. That's not the best way to learn this stuff. But yeah, that's how they did it back in the Roman Empire. But the goal in ancient Rome wasn't to have a fully literate society or anything. It was all just the aristocrats and that sort of thing who had to learn it. So, but still, you would think they would try and make it easier for them, make it easier to learn this stuff. Well, what do you know? But there are some things in the trading world that kind of work like that, where you learn it in just this really dumb way and it doesn't make sense until way, way later. because you're learning it in a dumb way. One of those things is a piece of technical analysis that we call support and resistance. We just memorize that, oh, well, I can connect these two dots that are two high points or these two low points or three low points or whatever. And oh, yeah, look, so there's this magic line that the stock is supposed to bounce off of. It's this sort of abracadabra magic or abracadarium, in this case, magic. I don't know. And that leads to just this profound misunderstanding of what support and resistance even is, let alone how it works. And that's what we're going to talk about on the show today. We've talked recently about how the trade objective lends itself pretty well to us using fundamental analysis. And that's because the trade objective is all about investing into a stock, buying it, or divesting from a stock or ETF, or selling it, and having an idea of what its value is pretty darn helpful stuff. But when it comes to the skate objective, meaning wanting to not get assigned, well, fundamental analysis is still a little useful, but technical analysis is a little better to lean on, I would say. Because when it comes to the skate objective, that's all about, hey, I think the stock won't go through this price, right? And so it's really more about the price. And is there anything that can indicate the likelihood of a stock going through or not going through this price? So we can use technical analysis in our wheel trading, but it tends to be different technical analysis than typical technicians or chartists use. Now, the one thing that we use, albeit a little bit differently, is support and resistance. So let's back up for a second and go kind of big picture. Technical analysis, or sometimes called TA, is the study of a security's past trade data, which can include price and volume, to forecast its future price movement. This helps traders make buy and sell decisions based on price action resulting from market participants' behavior. Most often, traders will study this trade data on a stock chart. So, technicians or chartists, as would be appropriate to call them in this case, most often traders will study this trade data on a stock chart. So technical analysts, or sometimes called chartists, make decisions based on price patterns or indicators that are used in studies that are either overlaid on the price chart or placed below it. This technical data has a different focus from fundamental data. It's not, this is what the data say the value is, so the price should be this, and if it's not, then I make a trade to take advantage of the difference between price and value. That's not what that is. Technical analysis is, this is what the price did. And so TA is more about the stock than the company. It's about price, not about value. Ultimately, technical analysis measures how supply and demand affect price. Technical analysis is a map of human behavior. I just love saying that. I'm going to say it again because it's really important. It's a very important statement. Technical analysis is a map of human behavior. To understand what I mean, we need to take a little bit of a rabbit hole excursion here and talk about market mechanics. How do stock prices rise and fall? Well, there's a lot to it. But the underlying concept, well, I mean, that's really pretty straightforward. When a trader enters a buy or sell order for a stock, along with the price data, the order also shows the number of shares that they want to buy or sell, right? I mean, that's intuitive. Hey, I want to buy 200 shares at $61.83. Those are the two operative pieces of data. The collective of all the orders in the market that show the price and the quantities that every trader in the market trading that stock wants to buy or sell makes up the market and the market depth. The highest bid is what we call the market bid. And the total number of shares bid for at that price is shown as the bid size. And that's same for the offer. The lowest offer of all the offers out there in the market is the market offer, or the ask. And the total number of shares offered at that price is shown as the ask size. Any bids lower than the market bid, or any offers higher than the market offer, are not shown in the market. It's just the bid and the offer, unless the trader is looking at market depth, which we'll sometimes call level 2 quotes or the order book. But let's stick to the market, right? Which is the bid and the ask, right? Let's stick to the market and how it changes based on shares changing hands. This is one of those scenarios where you got to think about the numbers. Concentration exercise. But I'll try and make it easy for you. Let's imagine that we're looking at a stock and the market is $83.91 bid and offered at $83.92. So we would just say $83.91 bid at $83.92. Okay, got it? Now let's say the quantity of shares bid is 500. That's the bid size. And the quantity of shares offered is 100. That's the ask size. So we're 83.91 bid at 83.92, 500 by 100. That's kind of trader lingo. Now, what if a trader entered a new order to buy, say, 300 shares at the ask price of $83.92? Well, there's only 100 shares offered there. So in basic market mechanics, what would happen is, because there's 100 shares offered at 83.92, as soon as the order to buy 300 at 83.92 goes into the market, the 100 shares that are offered there would execute, they would trade, and now there wouldn't be any more offered there. So the bid would become 83.92 for those remaining 200 shares. And let's presume that this is a pretty actively traded stock. So then there would probably be shares offered in the order book at the next lowest price, a penny higher, $83.93. So imagine there's 200 shares offered there. So now we would have those 200 that this guy's still trying to buy at $83.92. That's the bid. And now the offer is $83.93. So it's $83.92 bid at $83.93, 200 up. 200 shares on the bid, 200 on the ask. Now that $83.91 bid that I originally mentioned, bid for 500, well, I mean, that's probably still there. It's visible in the level 2 quotes, but now it's not the best bid, so it's not the market bid, so you wouldn't see it unless you're looking at the level 2 quotes, because now the bid is $83.92. And it's shown as such. If there's more demand and someone else enters a new bid to pay, say, okay, the offer $83.93 for, say, 400 shares, well, then remember, I just got done saying there's 200 offered there. So they would buy those 200 that are offered at $83.93 And now there's no more shares offered there. So the bid becomes now 83.93. And if there are shares offered at 83.94, that would be the new market offer. So imagine there's like 600 offered there. Okay, so now what do we got? Now it's 83.93 bid at 83.94. Do you see how the price of this stock is changed by buyers buying up the shares that are offered at a price? And any more that could not be immediately bought at that price becomes the bid? This is the mechanism for how markets work. And you know what? If you're like most of the traders that I've talked to in my whole career of teaching traders, you probably never thought about this and you didn't have reason to, but it's super important stuff. And people just don't understand it. I mean, I spent years and years and years, I spent a career as an options market maker. And this is what I did all day long, every day. If I had some option offered at $1.20 and I had 10 contracts offered there, and somebody came in and paid $1.20, I'd sell them my 10, but then, hey, you've got to pay more at $1.25 or whatever. If they bought those, then my next offer is $1.30. So I was kind of, along with the other market makers in my pit, the mechanism of supply and demand. They call it the law of supply and demand, not the generally good idea of supply and demand, not the suggestion of supply and demand or the theory of supply and demand. It's the law, because this is how everything works. All stocks work just the way that I described. All options, all foreign currencies, futures, anything that is a fungible commodity, basically meaning that they're all the same and there's a lot of them out there. Everything works exactly like this. And by the way, it works the same for selling also. If a seller sells all the quantity of shares that are bid at a specific price, then there's no more bid at that price. The bid is gone, and the next highest bid, one lower, is shown as the market bid. And when all the shares that are bid at that price have been sold, then the next bid is the next highest one there. So just down one more tick. Now, to be fair, in reality, it's a bit more complicated than this. But what I described here, that's the concept. Bidders buy up offers and replace offers, and sellers take out bids and replace those bids. And that's how the market mechanically goes up and down. It's humans buying and selling and taking out the quantities that are available. This lends itself to an excellent conversation of support and resistance. We've covered those two already. We've talked a lot about support and resistance, but now let's talk about why they work. If you were to look at a stock chart, and I'm looking right now at a chart because I'm pretty much always looking at a chart. I'm looking at SPY. So I guess technically not a stock chart, an ETF chart. And the day I'm recording this, and this won't be released for a couple of days, and if you're binging this at some point in the future, these prices could be way, way, way different. But as I'm looking at this right now, SPY, I can see that about a month ago, Spiders, SPY, got up to about 689. About 2 days in a row. It kind of kissed it both days, and then it came back down spent a little time lower, and then it went back up. And over the last week, there were like 3 days where it just kind of kissed that little line that I can connect between the prices a month ago and the prices now, those inflection points. Well, a month ago, when SPY went up to 689, why did it go back down? And I'm not looking for the reason, some political thing or economic thing or anything. I'm talking market mechanics. Why did it go back down? Well, because that is where the sell orders were. Okay? When it got up to that point, there were people who created supply. They put in sell orders to sell the bids that were there, and they took out all those bids, and then they sold more and took out all that bids and sold more and took out all that bids and pushed the price lower. That's what happened. And now we're back up at that price. And why aren't we through it? Because the buyers are not willing to buy all the shares that are offered there. Instead, the sellers keep creating supply and keep offering more shares there, so it can't go above it. The price is resisted. See how that works? When I said this is a map of human behavior, this is humans who have entered these sell orders. Now, yes, maybe there's some sort of algorithm and electronic trading mechanism where the computer's making the trades, but it was a human somewhere who programmed the computer to do that. Now, why? Well, it probably has a little something to do with fundamental analysis, go figure. There are professional traders and professional investors who run models that say, hey, the stock is worth this. Once it gets too far above this, start selling because it shouldn't be worth that much. The price is too high relative to the value. And vice versa. When it's too low, buy, put in buy orders. This is a map of actions that actually happened that were the decisions of humans. It's not just connecting dots. It's not magic. Abracadarium here. It's actual buying and selling that stems from decisions that probably stem from mathematical models of valuation. And it's the same thing. I'm looking at the same chart here, and I see that about 2 months ago, SPY got down to about 652. And then 2 days later got down to it again. And then fast forward a month from there, and oh, look, it got down to about 652 again 2 days in a row. But it couldn't get below that point. Why? Because the sellers who were selling, they were selling a certain quantity, but there was more quantity bid than they were willing to sell. And so the price was supported. The price stayed higher because the sellers were not willing to take out all the quantity that was bid. And then consequently, new bids came in just in the ebb and flow of trading, and they ended up buying up all the offers. The law of supply and demand. Not just connecting magic dots, literally a map of human behavior. And I'm very specifically talking about horizontal support and resistance lines. I mean, we can draw trend lines that are sort of diagonally sloping, and those are related to this as well, but that's more traders making decisions based on the technical analysis that is trend lines rather than very specific prices creating inflection points. This is how support and resistance is created. Resistance means the price is resisted. It has a hard time going above that price. Support means it's supported, has a hard time going below that price. But just because in the past, a certain price level had a lot of shares bid at that price, or offered at that price, it doesn't mean that those same traders will still have the same orders at those prices and in those quantities in the future. Orders to buy or sell a stock, they're a result of traders and analysts valuing a stock, like I said, with probably fundamental analysis and maybe even technical analysis. And at the time, their analysis revealed price levels to place their orders. But for support or resistance to not hold, for the stock to go above resistance or go below support, one of three things are going to have to take place. The first thing, the traders who created that resistance, let's just say, their model said that they should sell there. Well, I mean, at some point, they're going to sell all they need to sell. Then if there's buyers, there's no more shares to sell and the resistance will not hold, or vice versa if it's support. The second thing is, well, there's some traders who created resistance, but there's other traders with the opposite thesis, and they had more demand. They absorbed all of those other traders' offers, if it was resistance, and they still had more to buy. Their model said to buy more. And so they consequently break resistance or break support. The third thing is it could be that the inputs into the decision making of the traders who created the past support or resistance changed, which might have led them to cancel those orders that were at those prices. They don't want to buy it there anymore. They don't want to sell it there anymore. Maybe they want to buy it or sell it higher or lower. And support and resistance, they're important. But that said, chartists have another toolbox in the truck too. They have indicators. An indicator is a formula or other such data manipulation that can be used as a study in conjunction with a stock chart to help the technician or chartist more clearly understand price action. One of those is what we call a moving average. A very, very commonly used indicator is what's known as a simple moving average. A simple moving average is calculated very, very easily. It's calculated by adding up a stock's closing prices for a fixed number of periods, which for wheel traders, we're usually talking about days, where it closed on the day as opposed to closed every 5-minute candle. And then we divide that sum by the number of periods in the moving average to generate an average price for that period. That average is typically plotted for each period, which forms a line placed on the chart. And as each day passes, the next new day is added and the oldest day is dropped. Hence, it's a moving average. So like if the price goes from 100 to 101 to 102, if we had a 3-day moving average on the day of that 102, you'd take 100 plus 101 plus 102, add them together, divide by 3, and it'd be 101. If the next day it goes up to 105, then because it's a 3-day moving average, we're going to take just the last 3 days, and it'll be 105 plus 102 plus 101. The 4 days ago when it was trading at 100, that dropped out. So we add those together and divide by 3, and the moving average changes. The reason we do this is because this gives that line that's created a smoothed value of the stock price, and that removes the day-to-day noise. So in a sense, it gives us a little bit of a more clear picture. There are a few alternatives to the simple moving average. A lot of people use exponential moving averages. They're very popular. Exponential moving averages have the same moving one day in, one day out feature, but they give more weight to more recent prices, right? So it's not just this day plus this day plus this day divided by 3. The more recent price is given more weight. But there's several ways for wheel traders to use moving averages. And like, there's a lot of different ways. But one of the most useful ways is as, drum roll please, support and resistance. So here, instead of a horizontal drawn line at inflection points where the quantity of shares bid created support or quantity of shares offered created resistance, instead of connecting those inflection points, the support or resistance formed by long-term moving averages, they have sort of a little bit of a different concept behind them. The longer term 200-day moving average is really important for investors. And it makes sense why. If there's a stock that's trading below its 200-day moving average, that means it's underperforming its average price for a good part of a year. 200 trading days, not calendar days. I mean, that's a pretty darn good part of a year. There are some funds that have investment policies or prospectuses or just plain old risk manager guidelines that state that the fund is not allowed to hold stocks trading below the 200-day moving average. Not to mention, even if that's not the official policy, I mean, would you want to be the guy who's managing this billion-dollar fund and you have to show your boss and the people who are investing in your fund and who read the prospectus that you are holding on to an underperforming investment? That's a tough sell. So when a stock gets down toward the 200-day moving average, some fund managers might choose to, what a lot of people call, defend their position, which means buying those shares to keep it above the 200-day moving average so that it doesn't go below there and they don't have to sell it. Now, that is, of course, if they still believe that it's a good stock. Otherwise, I guess they'll dump it, right? But once the stock price breaks below the moving average, the 200-day moving average in this case, then support becomes resistance. And a lot of fund managers, like I said, they have to sell if it's below the 200-day moving average, and they have got big positions, like a ton of shares. And if they have to liquidate them, that is going to push the price still lower. And all that selling pressure of all the funds that need to liquidate, because the 200 moving day average is the same for me as it is for you, as it is for Charlie down the street. All the charts look the same. When all those funds all now need to sell the stock, that's going to keep the stock from rising back above the 200 moving average, which is why it now acts as resistance. See how that works? I mean, in a way, it's like a self-fulfilling prophecy, but I mean, it's more market mechanics. Another common use of long-term moving averages is to compare the 50-day moving average to the 200-day moving average. If the 50-day moving average crosses below the 200-day moving average, they call that a death cross. And the expectation is that the stock might see some follow through lower. When the 50-day moving average crosses above the 200-day moving average, well, it's called a golden cross. And that's a signal to technical analysts that the stock might climb higher. The rationale is that the speed of change is greater in the 50-day moving average compared to the 200-day. So the comparison kind of confirms a strengthening or weakening of momentum that might otherwise be hard to see on the chart. I mean, that's the purpose of all studies and indicators and such, to give a more clear picture than you can otherwise see by just looking at a chart. Even though it's common for wheel traders to trade much shorter term options, these 250-day moving averages that are most useful to wheel traders. Because remember, covered calls and cash secured put trades, they're not really directional trades. They're line in the sand trades, in which as long as the stock doesn't rise through the covered call strike or fall below the cash secured put strike, the premium becomes the profit, right? I use support in setting cash secured put strikes and resistance in setting covered call strikes, at least in part, on a lot of my wheel trades. And this is, I don't know, to me, it makes a whole bunch of sense when it comes to the skate objective trades. Support and resistance, whether horizontal prices or long-term moving averages, they don't just sort of give an indicator, they actually affect real life. They add a greater likelihood of success to skating. They actually interfere with the otherwise randomness of the log normal probability distribution that stock prices are thought to adhere by. If there's a lot of buy or sell orders at a particular price, then prices don't behave purely randomly. They don't behave like the log normal probability distribution. This makes support and resistance very advantageous when it comes to setting strikes because prices aren't really as random anymore, right? There is a catalyst that interferes with that randomness. So it's pretty darn special. And that about wraps it up for this show. But before you go, please make sure you're subscribed on your favorite podcast platform, whether it's Spotify, Apple Podcasts, or whatever it may be. And if you would be so kind, please, to leave a comment, I would really, really appreciate it. Until next time, invest excellently.
Options involve risk and are not suitable for all investors. Before buying or selling an option, read characteristics and risks of standardized options. A link is provided in the show notes. To learn more about your host, Dan Passarelli, please visit markettaker.com.